The S&P 500 kicked off the week yet with another record high as investors are convinced that tomorrow's Federal Reserve decision and this week's big technology earnings in the US could bring some positive surprises into the mix and help carry this rally higher. So welcome. This is Swissquote's Daily Market Talk. So yes, it was yet another day and another record high for the US major stock indices. The S&P 500 traded to 49.30 yesterday for the very first time, driven higher by falling US yields after the US Treasury surprisingly cut its quarterly borrowing estimate on hope that 5 of 7 magnificent stocks of the S&P 500 will surprise positively when they reveal their quarterly results this week, and on hope that we might actually hear something relatively dovish from the Federal Reserve meeting, which starts today and which will end tomorrow, and the decision will be announced tomorrow. And the dovishness is due to, well, because the inflation metrics have been favorable for considering relaxing the interest rates in the US sometime in the first half of this year, and also the manufacturing surveys look bad enough to give the Fed a reason to actually dial back this tight monetary policy despite robust spending and whooping growth numbers in the US. So here we are. The next few hours will bring a lot of fresh information to the news feed. As I said, the Fed will announce its decision tomorrow, and as chair, Jay Powell will speak to back the Federal Reserve's latest decision and give us some light and hint on where things are going. And before that, well, Alphabet, AMD and Microsoft are due to announce their latest quarterly results today after the bell. So in terms of pricing, Alphabet and Microsoft both advanced to a fresh record at yesterday's trading session, and AMD is trading close to a record high as well. So Alphabet's PE ratio is just below 30. Microsoft's PE ratio is just below 40, so both are not excessive numbers compared with the S&P 500's PE ratio that stands somewhere near 23 as of today, but AMD's PE ratio is approaching the 1500 mark. Yes, 1500, 1500. So anything less than mind-blowing in terms of results for AMD will hardly keep the stock on this exponentially rising path, in my opinion. But given the rapidly developing AI story, there is also room for positive surprises, both in terms of actual earnings and yearly forecasts for this AI stock. So if that's the case, the AI-related stocks will likely continue to remain seated on their cloud and make investors dream for better valuations, even though with these inflated valuations. Now, zooming out, the softer US yields on soft Fed expectations are also giving a positive push to the overall markets in general. The US 2-year yield remains steady near the 4.30% level. The US 10-year yield is headed toward the 4% mark. Small cap stocks are in a good or even a better position to benefit from lower interest rates, as these companies need cheaper financing more than the big companies do. Therefore, UBS, for example, says that the Russell 2000 index could actually be a good play in an environment of falling interest rates this year. Well, it sure isn't as exciting as your shiny NASDAQ 100 stocks, but in terms of price to earnings ratios, well, the index offers a way more reasonable price to value metrics. In the FX markets, the dovish Fed expectations prevent the US dollar index from making a decisive move above its 200-day moving average. Obviously, everyone is expecting the Fed to cut the interest rates from May this year and the US dollar to continue losing value this year. But I am more neutral to positive because I believe that the Fed's path to rate cuts may not be as swift as many think it will be if, of course, inflation numbers start looking bad again. Now, rents, which are the main responsible of the remaining inflationary pressures in the US, are expected to ease and be the major driver of inflation toward the Fed's 2% target in the next few months. Yet, Yet, gasoline prices, which fell more than 50% since the summer 2022 peak to the end of last year, and which helped bringing the US inflation down from a 9% peak, will start showing signs of rebounding since the start of this year. Now, for now, this rise is not alarming, but the base effect will likely play against the falling inflation trend in the US in the next few months, and it will actually be very interesting to see if the rise in rents falls sufficiently and soon enough to temper the rise that we see today in energy prices. So the latter may or may not actually prevent the Federal Reserve from cutting the interest rates in the first half of this year, but it will help investors for sure to scale back their 150 basis point cut expectations for this year. And that could eventually help alleviate the US dollar's valuation across the board. Elsewhere, the euro-dollar has been, benefiting from a limited courage from investors to sell the US dollar in the soft Fed environment, but the pair is extending losses below its 200-day moving average this morning on expectation that the ECB can't keep its interest rates at the current levels with the sputtering European economies. Because the European farmers are all around the countries and all around the roads and all around the place today protesting. The German industries are suffering. The growth numbers across the euro area look bad, and people are waiting for something to happen. So that something could be rate cuts. So this morning, the Eurozone countries will start revealing their inflation and growth updates gradually. The Euro area's aggregated GDP for fourth quarter is due today, and inflation for January for the Euro area is due on Thursday. The lower the growth and the slower the inflation, the sooner the European Central Bank will cut the interest rates. But if inflation surprises to the upside, we could see some of that European Central Bank dovishness vanish, and that even with gloomy growth numbers for the euro area economy. So we shall see support forming in the euro dollar into the 107.93, 107.75 area that includes the 50% Fibonacci retracement on October to December rebound and the 100-day moving average. In the energy space, crude oil remains upbeat after last week's positive price breakout above the $75 per barrel level and on the rising tensions in the Red Sea region, as everyone right now is now expecting the US to respond to the latest attacks in this region. So US crude saw resistance into the $80 per barrel level at yesterday's surge, and we could see some consolidation between the $78 to $80 per barrel level before potential breakout about the $80 per barrel psychological level. Now note that oil stocks are also better beat these days with the rising oil prices. In the sense, ExxonMobil rebounded more than 7% since last week and could well break above its September to now descending channel if, of course, Friday's quarterly results satisfy its investors. And speaking of energy, the green transition goals are being thrown to a garbage these days, because yesterday a hedge fund called Bluebell in London asked BP to cut spending on clean energy and boost its oil and gas investments. Instead, they said that BP is preparing to operate in a world that BP should know will not exist. So that's really rough anyway. BP and other oil companies will likely see the benefits of rising oil prices of the moment. BP looks like an interesting long position to me with a 500p target at the current levels. So this is all for today. I'm İpek Özkardeşke and thank you for joining me today. I hope this episode of Market Talk has been helpful and it has been insightful to you, so please do not hesitate to leave your comments, your reactions and your questions below as usual. And follow us on Instagram, on X and on LinkedIn for regular market updates, and subscribe of course to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, Good day trading.